Hi, everybody. This is Gary Dean, and this is our nightly video report for Thursday, December 8th, 2016. The Bulls tried to make another strong run today, and we kind of saw some weakness. It's midday around there, but we had the S&P that was up around 11 points, so we showed some continuation or some follow-through from yesterday's big run. But the same thing is happening. Is we're seeing the big boys selling the rally. So we've seen it every time the S&P has been up. They've been in here selling in blocks. Now, again, it doesn't mean that it has to turn right away, but it's a red flag that, when you see them, the negative money flow every time the S&P is higher, especially when it's higher a lot, then it's a red flag. And you can see even with the block trades here, there was a big discrepancy as far as what's going on with the S&P as far as the price compared to what's going on with the institutions. So let's take a look at the regular charts. On the daily chart, we still could be trying to back test this. Maybe it's going to head to the upper line. Not sure. It's right now the Bulls are in control, and they're going to stay in control until they're not. As much as some don't want to believe that this market won't run up forever, it's going to have a nail biter to the downside, and when it comes, it's probably going to catch everybody by surprise, because not a lot of people are expecting this market to ever go down, at least until sometime in 2017. So, yeah, it's going to. And where is it going to go? Like I said, I'm not looking at the start of a new bear market. I'm not looking at a huge move to the downside. I'm looking for a normal retest or backing and filling probably before they head higher. So a typical place they can go is 2161. That would be the moving average here. That would also be pretty close to the support. So anywhere in this area would make sense. If we look at it at a 60-minute chart, just a 23% retracement is 2212. So anywhere, this I would say would be the bare minimum as far as a retracement would be, the 2112. Now, you can see here where we have, say, 1, 2, this is 3. We maybe come down to this 2233 level, which isn't that far below. Find support and then head up, and what we'll do, that will be 5 waves to the upside. Doesn't have to go that way because we have enough waves from this low here. But in any case, right now the bears, they need to push it through this 2136. That should get the reaction trade down to the 2112, 2113 area. And like I said, that would be the bare minimum as far as just a resting place. Now, what would make more sense is we head a little bit deeper down to this 2188 where we test this support, and it would also be the 38% retracement. Give everybody a little bit of time to breathe a little bit, because we've gone up 1,000 points without any real breather whatsoever. And whenever they do that, we usually get the big move to the downside. Now, this one, we saw the S&P drop 70 points in the one day. It's and this is after it actually broke a little bit. But the thing is that when they push it up, eventually the buyers run out of steam, and from there, sellers take over. So, again, I'm not calling for a bear market or a massive drop. I'm just saying the bearish divergence is in place, the very extended move without a breather. I think buying right here is very dangerous. And like I said, a bare minimum move would be down to the 2212. That would be acceptable as far as a pullback to test some support and then move higher. Now, 15-minute chart, I had showed you this is kind of our projection chart, and I said that if we get above these levels here where we started, there's a chance that we're going to come up to the 2256. They came pretty close to it, 2151. But the selling from the institutions pulled things back. So if they do head higher, you can see here we have the bearish divergences as this was heading up. If they head higher, then it's still going to extend these, and what's going to happen is we're now going to have them on the 60-minute charts, and we know we already have them on the daily. So again, all of these are just warning signs. They're not something that says that this market has to pull back right away. What it's saying that if it does, it would make sense. And just buying recklessly right now, listening to the media and to anybody that's out there saying this market isn't going to go down, it's, if history is our guide, they're going to end up probably selling right before the low is going to come into place, and then we're going to get the next leg of the rally. So right now, let's see what plays out tomorrow. Like I said, I'm not interested on the long side. I don't care if they continue up. It's not my style. I'm not going to chase something after we've gone up 170, 180 points without any kind of breather, because it's just asking for trouble. And especially when you see institutions that are that are taking profits and selling these rallies, it's something I want nothing to do with. So with that, let's see what plays out tomorrow. Have a great night, and I'll talk to you guys in the morning.